Hi everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. In today's video, we'll be looking at the key lessons from the legendary investor Warren Buffett from his letters to shareholders over the last 40 years. Warren needs no introduction. He is the chairman and CEO of Berkshire Hathaway, one of the most robust conglomerates with businesses covering insurance, railroads, food and beverages, and even tech. Warren Buffett started investing at the age of 11, and in the last 80 years, he has generated several $100 billion and personally has a net worth of around $100 billion. This is despite pledging and actively giving away his wealth for philanthropic purposes. This will be a multi-part video series, and in this part we'll be covering two key lessons on market volatility shared by Warren Buffett in his shareholder letters. Before we start, if you're interested in this topic, please smash that like button so others can find this video as well. Now let's dive into the two key lessons on market volatility. Number 1. Ignore short-term movements in stock prices. For the layman stock investor, the price is everything. Buy low, sell high. There is even a Wall Street proverb to this effect. You can't go broke taking a profit. Buffett disagrees completely with this approach, and he ranks this maxim as perhaps the most foolish of all Wall Street's sayings. And with Berkshire's portfolio, he is adamant that the price of a stock is one of the least important factors to consider when deciding whether to buy or sell shares in a particular company. The company's operations and underlying value are the only things that matter to Buffett. That's because the price of a stock on any given day is mostly dictated by the whims of Mr. Market, Buffett's metaphor for the mercurial movements of the broader stock market. Without fail, Mr. Market appears daily and names a price at which he will either buy your interest or sell you his. Sad to say, the poor fellow has incurable emotional problems, Buffett wrote in his 1987 letter. For Buffett, investors succeed when they can ignore Mr. Market and his up and down emotional states. Instead, they look at whether the companies that they're invested in are profitable, returning dividends to investors, maintaining high product quality, and so on. Eventually, Buffett says, the market will catch up and reward those companies. In the short run, the market is a voting machine, he writes, quoting Benjamin Graham, but in the long run, it's a weighing machine. Number 2. Save your money in peacetime so you can buy more during war. In 1973, Buffett made one of his most successful investments ever in the Washington Post. At the time, the Post was widely regarded to have a value of somewhere between $400 million and $500 million, though its stock ticker put it at only $100 million. That was, for Buffett, a signal to buy. For just $10 million, he was able to acquire more than 1.7 million shares. The underlying philosophy here is simple. Hold on to your money when money is cheap and spend aggressively when money is expensive. In 1973, the country was still in the grips of a stock market crash that had begun in January. That slow-motion crash created a 2-year-long bear market. Shares of Coca-Cola, one of Buffett's major stocks, plummeted by 70%. Across the board, companies whose fundamentals had not changed were dramatically, in Buffett's estimation, underpriced. The Washington Post stock suffered too, even after Buffett's acquisition. After the end of 1974, the Post had officially been a loser for Berkshire Hathaway, falling from a value of $10.6 million to $8 million. But Buffett had a conviction the company's fortunes would turn, and he knew he had picked the company at a great price, despite the fact that it had fallen even more. By the time Jeff Bezos acquired the Post in 2013, Buffett's 1.7 million share stake was worth about $1 billion, a more than 9,000% return. Every decade or so, dark clouds will fill the economic skies, and they will briefly rain gold, Buffett wrote in 2016. When downpours of that sort occur, it's imperative that we rush outdoors carrying wash tubs, not teaspoons. For now, that's it from us. Hope you enjoyed and learned from these lessons. Subscribe to make sure that you receive the follow-up videos on key lessons from Warren Buffett. Thanks for watching and smash that like button.